market's petering out as well? I don't think so. Look at the JSE, it's up another 0.4% almost, to another all-time record high. Every single day for I think the last 3-4 trading days, it's been an all-time record high. Do the macroeconomics back this up? In the studio with me now is Johann Els, who is a senior economist at OMIGSA based in Cape Town. Johann, thanks very much for popping in. You did a presentation about a week ago in Johannesburg. What was the message coming out of OMIGSA?
The main message is still low interest rates for long, and probably much longer than we anticipated a couple of months ago. With all the fiscal problems, all the debt problems, central banks are going to do their utmost to make sure economies continue to grow. And whether that's interest rates at low levels for very long in developed markets, or lower interest rates in emerging markets, and probably more quantitative easing. But it all means that markets are liking this. Low interest rates are good, quantitative easing is good for the markets, and all that low interest rates means we're looking for, or foreign investors are looking for return, looking for yield, and that's why the rand is so strong. They keep on piling into South African bonds. And of course, that's good for us as well. If we want to buy South African bonds, we get the benefit there as well. But that search for yield will be with us for a long time.
There's been an extraordinary speculative position building in the South African bond market. I mean, it's not yet to bubble proportions, but I mean, every time I have a look at my screen in the mornings and one of the big banks sends me the figures, it's just growing and growing every single day. But I mean, it's a no-brainer, isn't it? I mean, the rand's relatively stable, and our yields are very high.
Yes, and I think that can continue for some time. There's nothing deterring foreign investors. Well, at the moment, they're not looking at South African fundamentals. They're not worried about South African politics. They're not worried about big current account deficit. They can get a better return here.
So they just look at the numbers. I mean, they don't analyse. I mean, obviously they know what's going on, but it's a relatively small part of their portfolio. So they say, well, I've got 5% here, and I've got this inflation here, and I've got a rand that's doing this, which they can manage anyway via their sophisticated instruments. So they pile money in.
It's, as you say, a no-brainer. And as I said, it will probably continue for some time, many years probably. So we'll continue to get the benefit of that. Unfortunately, you know, for those people who are wanting a weaker rand, it's probably not going to happen soon, but there's always that risk. Given that the current account deficit is so big, at some point, and that point will probably come when we see significant better growth numbers in the USA and Europe. Then we'll anticipate higher interest rates in the USA and Europe. And that's the point when foreign investors will say, hang on, this risk isn't that great anymore. We can get somewhat better return in the future in the USA. But having said that, that's some time off. That's a few years off.
Well, Mr. Bernanke and his team, I think, said that it's going to be, what was the year now? I can't even remember. I think it was 2014.
Late 2014, and some analysts expected...
It's 2 years away.
Yeah, some analysts expected them in their meeting last week to extend that into 2015, and that might still come. But even the Feds, the members of the FOMC, their own forecasts show that when it starts rising into 2015, it's going to be a slow upcycle in terms of the interest rates.
And often the markets respond very positively to raising interest rates as well, because that's a signal that the economy is doing well,
exactly.
And therefore they're sort of checking demand.
We've seen in the past that equity markets still perform well into an upcycle in interest rates, exactly as you say, because the economy is doing okay.
So when the interest rates are super low, which they are at the moment, and they'll stay super low till 2014, the market reacts to the upside. When they start to go up from what you've just said, they also often respond to the upside. So it's perfect. So we should be in equities.
We should, well, you want to be diversified really, but you want to be as big in equities as you can, because low interest rate environment, quantitative easing, all of that is good for equities. It always has been, and as you started your segment off, the markets are showing us that. At the moment, I think we're almost in a Goldilocks scenario, where the better jobs report out of the USA last Friday showed the markets, hang on, the US economy isn't dead. There's some life in there, but it's not so strong that quantitative easing is totally off the table. So we're in that position where the Fed certainly will still consider another round of quantitative easing, but the economy isn't dead. So markets are loving this. And as you know, US corporate profits are at all-time highs, whether at absolute levels or compared to GDP. So companies are doing well. They're earning a lot. So that's why equities are doing well.
But the market can't have it both ways. I mean, the run-up to ECB meeting and the run-up to the Fed two-day meeting of last week was the market was going up because of the anticipation of some kind of a giant new stimulus package. We didn't get that, and yet the market still went up. So on the one hand, it should have been disappointed because of no QE, but on the other hand, because of the jobs number, it went up anyway because of no QE. I don't quite understand it.
And also the ECB meeting wasn't that bad. So they at least gave us a roadmap. We're saying that, now, unfortunately, these countries like Spain and Italy have to apply for assistance, but this isn't the assistance that Greece got. This application for assistance is to the EFSF, the European Stability Fund, to buy their debt in primary markets. So it's not a package like they gave to Greece. It's an application for buying the bonds in the primary markets. And the ECB said then the ECB will then also in the secondary market buy those bonds. So it's all bit more clear-cut that those yields on the debt of Italy and Spain will be coming down, which makes it a bit more affordable, which makes it a bit easier on the economies. So at least we didn't get the bazooka, but we're getting a roadmap.
Yeah.
And it's still going to take a long time, but it's working.
It's a hell of a long time. You know, I was just watching CNBC International this morning, and they did a piece, and it's almost exactly to the day 5 years since the crisis started. And it started off with Banque Nationale de Paris stopping funds being sent, freezing funds or something like that, and they went through a whole series of events. 5 years, and when suddenly we get a roadmap, I mean, congratulations.
Still, I think it's going to be another 10 or 15 years before we're out of this, which re-emphasizes my point about low interest rates for long. So, yeah, the global economy isn't great, but it's growing. It's not 2008's recession. It's growing at a slow pace. And at some point, you know, all this low interest rates, quantitative easing will get some traction in the economy. So I think you should keep at the back of your mind there's the possibility at least of an upside surprise in the next year or so.
And in 5, 10, 15 years' time, when we finally sort out the European problem, there won't be any Angela Merkel or Rajoy or Monti or Draghi. They'll all have gone on and living in their villas in Sardinia. There'll be new politicians there, but everything will be fine. And the JSE Securities Exchange all-share index will be 45, 50, 55,000, one would presume.
One would hope, certainly.
Exactly.
Lots of problems in the SA economy, but we seem to keep on growing. We're not growing where we should, but at least growth continues. And yeah, equity markets respond to growth.
They do, but there is a problem. I mean, some people that I speak to say that we're going to get growth of below 2% for 2012 and maybe 2013 as well. Other people say that because of what's happening in the United States at the moment with food prices, with the drought, the very severe drought, the worst for many decades, is going to mean that South Africa's inflation rate will start to rise again, and therefore maybe interest rates will not be cut again and maybe even rise in the future. So there are a few headwinds. I mean, I don't want to rain on your parade. But are there any potential banana skins that you are factoring in at OMIGSA?
Yeah, as you say, we've also revised our own GDP growth forecast for this year downwards from 3 to 2.8, and we're now at 2.5. And I don't anticipate us revising that down further. But 2.5, yeah, it's nothing exciting. At least it's not a recession. Food prices, as you mentioned, yes, it's a risk. In any case, I don't think the Reserve Bank will want to go down the route of a whole cycle of interest rate cuts. Maybe food prices will limit that. But they're certainly more focused on growth as well, and I think they showed their hand in this last cut that we did see.
That was a surprise. I mean, that cut was a surprise to many people. I think most economists that were polled, you probably were part of the party that also said 5.5% will be maintained. There were a couple of people that suggested 5%, but it was a surprise. And a lot of people said the reason that Jill Marcus and her team cut was because of those headwinds that she sees in the future, and therefore some people took it bearishly. Do you share that sort of view in the back of your mind?
I'm not too bearish on that, no. But I think that she's been warning enough over the last couple of months that you see the impact from the euro area on South African growth. So, yeah, it was a surprise to everybody, but we should have seen it coming, given her worries about the European impact on us. So certainly that is a worry. I don't think they're going to cut again. And the example that must be clear in their minds as well, and what we're thinking about, is 2001, when they cut early in the year, and they cut after the September 11 attacks when the US cut again. The current account was already in a deep deficit. The rand has already been moving weaker, and then suddenly, remember, December 2001, the rand collapsed. Interest rates had to go up again. And that cut was after a series of lots of cuts, stability after a long period of time. That must be at the back of their minds, given that our current account is already, once again, in a big deficit, 5% of GDP. So you don't want the risk of a rand getting the skeets, banana skin, that you ask for.
Are we out of the woods? Are we out of the woods now? We've had this sideways churning pattern. I know you're an economist and not a fund manager, but of course you work with your fund managers very closely at OMIGSA. Are we out of the woods now because we've broken up? Suddenly, having done this, we're now starting to do that. We've soaked up every piece of bad macro news from every single geography in the world, including our own. Is it now the time to say, thank goodness for that, let's get on with looking at earnings?
I would hope so, but unfortunately, I think the best we can hope for is sideways trend. We're still going to see lots of volatility. The past 5 years, as you mentioned, in terms of the euro debt crisis, we're still going to see bad news, good news, bad news, good news. Expect volatility. That's the only decent answer I can give you. But given that interest rates are low for a long period of time, I would assume that the bulk of the bad news is behind us.
Yeah, I would hope so, because we can't really take much more, and we've taken it very manfully, haven't we? I mean, the markets and the investors and everybody. A few wobbles here and there, but goodness me, that JSE's done well.
It has surprised many, many people, yes.
Yes, it has. Johann, thanks very much for coming in this lunchtime. That's Johann Els, who's a senior economist at OMIGSA.